again, the higher the number, the better. So pretty simple. It indicates efficiency of converting revenue to free cash flow. Free cash flow, for those who are unfamiliar with this term, is basically the lifeblood of every company. Without free cash flow, companies cannot reinvest. They can't grow. They can't pay us dividends. All those things are necessary. Think about free cash flow as like the money you have in your checking account. So the money that you air quote have left over at the end of the month, which we never do, that is the money that you can use to go out and spend it on things you want. So that's what free cash flow is. The next one is free cash flow yield. And basically what we're doing with that is we're trying to measure the return we would get on an investment if we bought it based on the free cash flow. And what it's doing is it's comparing free cash flow to the market cap of the company, which is basically taking the price that it's trading for in the market, multiplied by the shares outstanding, and that gives you the market cap. And so the higher the number. So if you find a company that's trading, like let's say Visa's trading at a 5% free cash flow yield, that's awesome. That's really good. So the lower the number, not so much. It just basically means that it's an inversion of the price to free cash flow. And so what it's telling you is that that's the return you should get. You would get to expect for buying $1 of free cash flow for Visa, for example. And then the final one is free cash flow conversion. And this is basically comparing the free cash flow the company generates to the net income or the earnings of the business. And again, the higher the number, that it just indicates efficiency, that they can take the earnings and create a lot of free cash flow for all the other things we talked about. So those are the three ones. So you want to talk about free cash flow margin and kind of what your thoughts are on that?
Yeah. So I would say in general, it should be close to a company's net margin or their net income margin, basically the basic profit margin. And I would say net income margin and free cash flow margin maybe get less attention than something like operating margin, but I would say for good reason, because net income can swing a lot from year to year. So can free cash flow can swing a lot from year to year. A retailer like Target or Dick's Sporting Goods, they might have a little, like years where there's just very little free cash flow because they're buying up inventory to ramp up for a lot of future demand, or they might have like too much cash flow where they've really pulled back their investing on inventory because they expect to slow down. So because they slow the reinvestments, they're getting all this cash from stuff they sold last year or 6 months ago. And so you really do see a lot of fluctuations depending on the type of company in the free cash flow. And so you will see fluctuations in the free cash flow margin and potentially the net income margin. So to me, if I was using that as a apples to apples comparison, try to remember what industry they're in, what type of business it is, and also that you're looking at a longer time frame to let those free cash flows smooth out rather than just taking 2024 or 2022. Try to put those in context.
Yep. That's great advice. And a good practice is to compare what the company has done. Like I like to look at a 1 year, a 3 year, a 5 year, and a 10 year, like rolling numbers to get averages to kind of see how they've done historically and more shorter term. The pandemic we're not that far removed from that. And some companies more than others could have been impacted by this particular situation way more than others. And so you have to take that into account. And I think so looking at shorter periods and longer periods can kind of help, as Andrew said, kind of smooth that out.